Hi there. Welcome to the meetup.
Hello.
So yeah, you can feel free to have your video on or off, whatever you choose. And yeah, we're just kind of hanging out, seeing if a few more folks show up. But in the meantime, if you have any questions, feel free to ask them.
All right. Thanks so much.
Yeah, no problem. So are you like a new investor, or where are you at? Yeah.
Well, currently it's something perspective that I'm looking into doing.
Mm-hmm.
And yeah, I'm really excited to learn more.
Okay.
Yeah.
Well, great. Welcome.
Thank you.
So I'm thinking if what we can do, I don't know how much information you actually have or what about apartment investing, but we can kind of go back and forth with questions that you have, and also I've got a deal here, so I could work on trying to do some screen sharing, and it's a an offering that I invested. It was the first offering I ever invested in. So it's one that I'm currently getting distributions from and things like that. So I figured we could go through it and kind of walk through what that looked like.
Okay, sounds great.
So but we'll give it a couple more minutes here. Where are you from, Sheree?
Knoxville.
Knoxville. Okay.
Yeah.
How'd you find out about the meeting?
So a friend of mine and we are thinking about going into apartment investing together. And so she sent me the Meetup link.
Okay.
And yeah, like a couple hours ago. I'm like, okay, yeah, this is exciting. I'm gonna jump on and check it out.
Great.
Yeah.
Well, cool. Yeah, this is so what I do, I've invested in 6 different deals passively. So on the limited partner side. And so that's something that I've used to create passive income for myself and cover bills and things like that. And so it's worked out really well for me. Are you wanting to maybe be more active in what you're looking to do then, if you're looking to partner with somebody?
Yeah, definitely. We are looking to really like go hard, and she knows a little bit more about it than I do. So, just jumping on with it with her, thinking about going all in.
Mm-hmm. Gotcha. Okay. Welcome, Kelly. Good to have you here.
Hello, thank you.
So, Kelly, if you have any questions at any time, feel free to ask. What I'm thinking I might do is go through an offering that I invested in about 1.5 years ago, or 2, maybe it's getting close to 2 years ago now. So, but that way you'd have an idea of some of the deals that I've looked at and how to kind of go through it.
Okay.
So, well, great. Since there are a couple of you here, I'll go ahead and get that started. I'm going to try this screen sharing thing. So you guys can see this offering here, the thing that I'm scrolling through. So,
Yes.
all right. So this is Carrington at Briar Creek. I invested with passiveinvesting.com. And this was the first deal that I ever invested in. Not the first deal that came across my desk, but just the first one that I decided to invest in. So, and there's a lot of the different information on there. The kind of lawyer-esque stuff. Okay. You'll see your table of contents and stuff. So typically you'll see the executive summary, which kind of just goes over the bare bones assessment of things, investment highlights, the overview, financial analysis, and some different case studies and things that compare it to the surrounding area. So let's look at some of these numbers here. So the main numbers that I like to focus on are some of the expense ratios. So you want to make sure that your expense ratios are healthy. So you're looking for a number that's under 50% there. And then let's see, obviously the purchase price is pretty high. Your equity required is right in here to make the purchase. Okay. So hold time is 5 years, and then your investor equity multiple. So if you're looking at this from a passive investment standpoint, you're looking to possibly double your money every 5 years. That's kind of the goal with a lot of apartment investments. And so what you look for is that equity multiple. So an equity multiple is just saying what your money is worth at the end of that investment hold period. So if your equity multiple is at a near 2x point, then you're doubling your money. Okay. So sometimes you'll see a hold time of 7 years. Sometimes you'll see it as high as 10 years. And so you can adjust your equity multiple accordingly for that, for your own assessment purposes. So your annual returns, this is without the sale price, without selling at the end of 5 years. That's what your returns will look like during that 5-year period. When you add in the sale at the end of year 5, that's what your overall returns look like. Okay. And your IRR is your internal rate of return. That's basically a time value of money calculation. I like to look at equity multiple really and seeing how much of your investor returns come from the sale. So as long as you're getting healthy returns along the way and then a nice bump at the end, then that's kind of where I like to be when I'm looking at an investment property. So and your internal rate of return, like I said, is affected by time value. So that would be a higher number if you're getting more of your investment proceeds earlier on. So if your profits are higher in the beginning than they are in the end. Okay. But the more that goes towards the end, then the lower that number becomes. So anywhere between 12 to 18% is pretty common for an IRR in the apartment investing space. So here you can look at your location. This one was in Raleigh, which is a great location. And then you've got the value add opportunity. So this is just, again, your summary. They go more into this later on. So then you've got your loan information and that the rents are below market. And so they've done their research on the market and seen that these rents for this particular property are well below market. You can see an average of $258 per unit. So this is something that you want to have that room for growth. If you're going to have a value add opportunity, you want to be able to increase the market rents because that ultimately increases the property value when you go to sale. So here are your investor returns based on a $100,000 investment. So for this one, this is what it looked like for a $100,000 investment. And you can see that in year 1, you're getting 7% returns, and that cascades up a little bit over time. And then of course you get some investor returns plus your sale of the property, which is why this number is so big. Okay. So the idea is that here you are getting paid in year 1. Okay. So that's something to look for, is when you are getting paid those investor distributions. Anywhere from 6 to 10% is pretty common for these. And so 7 to 8% is a very healthy return along the way. And so that's where you get that 8.1 average that we saw up here. So if you were just talking about cash distributions without the sale, that's what your cash distributions would be on average throughout that 5-year period, would be that 8.1%. So anybody have any questions about any of that?
So quick question, even though the equity was 14 million, so there's multiple investors in this one property and it's broken down by the 100,000?
Yeah, so this is an example. So
Okay.
yeah, this is just an example of a $100,000 investment. You may have investors that invested, 200,000 or 50,000. 50,000, I believe, was the minimum for this investment. So, but yeah, the 14 million is comprised of many different investors.
Got it.
And so, you know, and that's part of why the minimums for many of these investments are set at 50 to 75,000, because you can imagine if you have so many different investors getting to this 14 million mark, that's a lot of different investors that you have to kind of keep track of. So that's why some of those numbers, you know, for what an investor can put in are higher to start. So but yeah, this is just an example. A lot of times $100,000 investment is just easy to look at, you know, because you can look at your returns. Obviously 7% of $100,000 is $7,000, you know. So it just makes it a little easier to look at. So
Yeah, okay.
Here's another thing too, the partnership structure, and this is pretty common. So the investors get preferred returns. Okay, so they get returns before any of the general partners do. Okay, and then the cash flow is split 70-30 after that, and so that's typical for a deal. Is that you know, the general partners own anywhere from, I've seen as low as 10% of a deal to as high as 40% initially. And so the 30% here is the general partners, 70% is the investors, the passive investors or limited partners. Okay. So then once you hit that 16% IRR, then it flips to a 50-50. And this is a common thing. This doesn't affect your estimated returns at all. This is just saying, hey, if we hit that 16% and it goes over that, then you're still going to benefit as an investor, but we're going to take a bigger piece of the pie because we've overperformed what we promised anyway. So that's something that benefits the general partners and is an incentive for them to do better by you. So yeah, this was a 270 unit. You can see the occupancy was 97%, and it has remained in the 90s throughout the time that I've been a part of this property. And then let's see here. So average market rents are $1,100. And so these are the different highlights. So you can see they have some different plans for what they want to do. They are going to put in more money to get the curb appeal up. This was a class A property. Okay. So you've got different classes of properties, A, B, C, and D. This was a class A. Okay. And so that means that it's going to be higher on the amenities. It's going to be higher on the rents. It's going to attract people who have higher paying jobs, who can afford those kinds of rents. And it's in a generally a more wealthy area. Okay. So, let's see here. So yeah, obviously solid demographics fundamentals. Again, talking about people that have really good incomes in a booming area. Lots of retail around, top job centers that are well paying. So yeah, they want to do things for the curb appeal, and they want to work on that interior value add. So here are some of the things. So they were renovating the leasing office and clubhouse, make it more modern, upgrading the pool furniture. Let's see here. Yeah, pretty much. They went through and did do some other upgrades. And so you'll see the average premiums that they expect to get off these upgrades are around $262 per unit. So that comes out to, you know, be pretty substantial. So you can see the current kitchens, they're nice, but that's not your high. It doesn't look high end. So they're coming through and really upgrading these to make them look more high end. Okay. So, and that when they're able to do that, then they can command higher rents, and that's just the way that it works. So the way an apartment, is valued is different from a single family home. And so that's something I think that's important to go over. The value of an apartment is directly related to the amount of income you bring in versus the expenses. Okay. So if you can drive the rents up in a property and you can keep your expenses low, then you're directly adding money to the bottom line of what that property is valued at. Okay. So that's different from single family properties, which are greatly affected by the neighborhoods in which they are and things like that. So you could have the same home that's, here where I live in Winston-Salem, North Carolina. You could have that same home and take and put it in LA, and it would be worth 3 or 4 or 5 times more. Okay. And that's just the reality of it. Even though you might not be able to command tremendously more rents to make that difference up. So that's different from the apartment space, where it is just about how much money you can command for a property. So let's see. Oh, and this is another thing that you'll often see: utility chargebacks. So a lot of apartments, when they're first taken over, the previous owners had, perhaps the rent also covered utilities. And so what you can do as a new owner is go in and start doing, you can either keep doing that, but have a higher chargeback of those rents, or you can try to have separate meters and separate things that allow you to keep track of individual units, and have them pay their own utilities. And so that's something that you'll see a lot in a lot of these offerings. So you'll see that with these, the utility chargeback rate isn't up to the current market rents. So, I mean, anybody that owns a home knows that utilities have gone up over the last 5 to 10 years. My water bill used to be $70. It's 130 now. Just is what it is, but that's the reality. And so you have to keep track of that in order to, not just be spending more money. So, yeah, let's see. Any questions so far? Moving right along. So you can see that a lot of these will have all this information, and it looks very overwhelming. And, so this is good information to have. There are a lot of different employers in the area, so you can see how close this property is to all these different employers. Okay. And then how close it is to a state park, and how close it is to the international airport that's nearby. Okay. So a lot of great things about this particular property, which is ultimately why I ended up investing. So let's see what we got here. So property overviews. This is when it gets into some of the nitty-gritty stuff. So you can see all the different utilities and stuff, how that's taken care of, and who pays that, stuff like that. So the residents pay for all these things, which is good. So all of the different amenities that are there. You want to have good amenities for a property. And so, one of the other properties that I have, they came in and there was just this empty field. There was nothing in this field. So they were able to purchase a really nice playground set and put that in there, and develop a playground and dog park area for this this apartment community. And it really helped to kind of bring that community together a little bit, and add value, because people didn't have to drive somewhere else to take their kids to the park. Their kids could play on the playground right there, and it just added a lot of value to the residents' experience. So let's see here. So you can just see, I mean, this is all pretty standard stuff. So current interiors, how they look, and then the actual renovated properties. Now, obviously, they're not going to put beds and couches in the new units, but this is the potential of what the showrooms look like when they're showing them off to residents. So you can see just the higher amenities here. Just it looks higher end. So we already went over the kitchens. Here we're getting into the different floor plans and the unit mixes, and what the market rents are. So obviously this is all affected by the square footage, the type of units. So this 270 unit has a really great unit mix. So, but all these different things come into order. So your smaller units, they're going to be charging a little bit more for some of these people just trying to get a foot into the community or whatever. And then you can see how it's right around that area. So that's going to be interesting when we look at later the comps, the comparables, to see how it looks versus those. So, and you can see too the percentage of those units. So most of the units are this 2x2, 2-bedroom, 2-bath unit. That's almost 2,000 square or 1,200 square feet. So here's the layout, financial analysis. So here we go. All right. So your loan to purchase price. So here's you're basically putting 20% down on this property with the loan. And that was the idea. Interest rate was 4.8 at the time. So, and then interest only payments, you'll see this interest only payments are pretty common in the apartment investing community. And what that allows you to do is it keeps your expenses lower, because an interest only payment is a lower monthly payment that you have to pay on that loan. And so the idea is that you use the extra capital that you're saving in order to really carry out your business plan in those first couple of years. And that allows you to drive the rents up and really establish that you've carried out your business plan. Now you can go through potentially a refinance event and provide investors with a large portion of their initial capital back in their pocket without it being a taxable event. So let's see here. Assumption fee, that's a fee that's charged to investors. It does not affect your overall returns. It's not something you really see, but that's a fee that the general partners collect along the way. So that's not surprising. Let's see here. So return on investment overview. We kind of already looked over all these numbers, so I won't stick there. Let's see. And we just looked at these things. Oh, actually, I'm sorry. The assumption fee is the with the debt financing. So that's the banks. The bank's charging a 1% assumption fee. My apologies. So you can see these are the projections. So your gross income minus your total operating expenses is what gives you your net operating income. Okay, and that net operating income is what your property value is directly based off of. So you can see in this 5-year period, they are looking to add about $1.15 million in value to this property, in their net operating income category. Okay. So that is about a 40% increase in the price of that property. So that's pretty significant when you talk about selling a property later on down the line. So let's see here. Let's see if there's anything in here that I need to go over. So you can see, your payroll expenses are going up incrementally. Contract services are higher in the beginning, and that's because you're doing more of your renovations in the first couple of years. And then so the first year really, it kind of goes up, and then slowly escalates over time. Let's see here. Your turnover rates are about the same, but you don't want it to go crazy there. Utility prices go up over time as well. And so marketing prices, you can see, so this is your trailing 12 months. So this is what happened in the last year prior to purchase. Okay. So the marketing, they only spent $27,000 on marketing this property. The incoming group is looking to spend more money on the marketing efforts to bring more people in and, have some of the turnover occur so that you can have higher rent prices as well. So property taxes obviously go up over time pretty significantly. Cash reserves, that's a common number. I think that might be about all I really need to cover here. You know,
What's your comfort zone for your occupancy rate? You said it was 97% for these buildings.
That's a very good question. So these buildings are currently in the 90s. Okay. So, but the break even point for many apartment buildings is actually in the mid 60s to maybe low 70s range. Okay. So what that means is that you can have your occupancy dip down into the 70s and still be able to make all of your payments, meet all your debt service and everything else. Okay. And it's no different than kind of the house hacking strategy. If you see somebody that buys a threeplex or a fourplex, they live in one unit for free while the other 2 or 3 units pay for their rent, and it's able to cover everything. Okay. It's kind of that same thing. You just have a larger economy of scale here with 270 units. So, but the general idea is that you don't want to, you want to have a you want to have a break even point that makes sense. So if I see a break even point that's at 75%, now I'm starting to maybe get a little itchy. And so I haven't seen that in here, but I want to say it's in here somewhere. But yeah, so you want to have a break even point that is in the low 70s to below that. I've seen it as low as 56%, you know, which basically means that, you know, in a 100-unit building, as long as you rent 56 of the units, then you're covering all of your expenses, which is pretty amazing. So anything over that is profit. So does that answer your question?
Yes, thank you.
Okay. Let's see here. So yeah, basically, I mean, what you can look at here, in year one, you're making $4.3 million. Your expenses are only 1.6. So, you know, essentially you could take a huge hit in your rents here and still be able to cover all of your expenses. So you like to see this cushion. So, and that's what this number is here. This is saying that your expenses are 36% of your income. Let's see here. So these are the rent comps. Okay. So these are your average areas around. So you can see Carrington is the one we're looking at here. It was built in 2003, has 270 units. Okay. And that's the one that we are really looking at. And then these other properties that are in the area, you know, they're B plus to A assets, which is kind of where this property sits. It's like an A minus B plus asset. You can see where the average rents are. So Carrington, for their one bedroom, one bath, current rents are over $1,000. Okay. And that's this price per square foot. You can see how it looks compared to the other places around it. Okay. Same thing with this one bedroom, one bath. Okay. So you can see that they're right there in that area. Carrington down here, when you look at their 2-bedroom, 2 baths, they're on the lower end. So that shows you that there's room for improvement there on their rents. They can bump the rents up pretty significantly and get into this range here. Okay. So that's where they say when there was $250 room to move up, that's where they're getting that information from. So, and you can see where for three bedroom, 3 bath property, you know, there's really not much of a comp, but man, that's a steal right now for whoever's living there. Because you're not going to find another place that's that cheap anywhere. So, and then your sales comps, this is just showing you, you know, what the different prices per unit were for these different places that were just sold. So, this sensitivity analysis, that's something that can be pretty useful. So this is, again, where we're talking about your break-even point. So basically, you know, at 65 to 67% occupancy, that's kind of your break-even point is in the mid 60s here. Okay. So that's a pretty powerful thing, considering you have a property that hasn't dipped below, I think, 92% since they've owned it. So all right, and we've already kind of looked over the market overviews and stuff like that, so I don't want to spend too much time on that. Obviously there's a lot going on in the area, and this is all stuff that's kind of, you know, just additional information for you if you're an investor and you don't know the area. Then this is really good information to get. So I live, you know, within an hour and a half or so away, so I already know the area fairly well, which is another thing that made me feel comfortable with investing. So let's see, portfolio and case studies. So these are, I believe, some different, yeah, these are different properties that this group has owned and renovated, and what they've done with those properties. So you can see how they've done these different purchases, and they've got extensive experience with these size units, you know, these types of units out in Texas. So they've also had a property that was, you know, they're moving to the Carolinas. This is a group that's centered out of South Carolina. So but yeah, these are, so it's very common to see in these different investments, you want to see a track record. You want to see that the operators that you're investing in have done this before and done this successfully, you know, and that they've done the kind of thing that they're saying that they're going to do. Okay. So this is basically their portfolio. They're showing you their portfolio to say, hey, look, we are able to do what we say we're going to do. Okay. So yeah, I won't spend too much on these unless you guys want me to, but they've been a busy group. So, and then of course you'll see your sponsorship management team. These are the three guys that head up the passiveinvesting.com team. So, and then there's a co-sponsor of the deal. So yeah. Oh, and here's some information about the property management team. That's something that's important too, is to know who your property manager are going to be, and what their experience level is with these types of properties. That makes a big difference, and the comfort level that the operators have with the property management team. I have been involved in deals where they had one property management team that they brought in at the beginning, and it didn't work out. And so within the first 8 to 12 months, they were replacing the property management team, you know, because that property management team wasn't up to snuff. So that's something that you expect your operators to take care of. You know, they're going to be on top of that. And if something's not working with property management, they need to make a move instead of just kind of sitting on their hands and letting an investment not go the way it's supposed to. So, you know, and preferably you'd like to have, you know, the property managers that come in, you want your operators to have worked with that group before, to already have a rapport with them. So that's a question that often gets asked. And then of course there's the different real estate terms and definitions. So all kinds of fun stuff. So, all right, I think that's probably about it for this deal. So I'm going to stop the share and bring it back. So what kind of questions do you guys have for me?
For the investor, you know, the annual interest, does that get paid out annually, or do you have to leave the money in there to the end of the 5 years?
Great question. So the way that that typically works, it's one of two ways. It can either be paid out monthly or it can be paid out quarterly. So I'm involved in deals that do, you know, one or the other. And and that's money that goes to you. So you know, for instance, I'm currently invested in 6 different deals across 4 states. And we 2 of those are in IRAs. My wife has a self-directed IRA that we've used to invest. But also the other 4 deals are outside of that, and those actually produce passive income for me. So that allows us to cover our bills, and that's all income that is produced from those investment deals. So, but it's a mix of monthly and quarterly payments depending on which deal. So this deal that I just showed you, that was a monthly deal. So yeah.
Okay. And then at the 5-year mark, do they always sell at that point, or do they ever keep it if it's profitable for longer?
So what can happen more often than not is that they would actually sell it sooner.
Okay.
Because what happens is you start to lose some of the benefits of depreciation after that 5 to 7 years, because you've already depreciated everything that you can, and you've got your money kind of tied up in that deal. So it makes more sense for the investors to be able to get their money back and get that bigger chunk of from the sale, and then be able to redeploy that into another deal. And so the operators work on doing what's best for the investors, and so that's why they work on a refinance, you know, around year 2 to 3 to try and give you capital back, and then you can reinvest in another deal, and then you're kind of snowballing at that point. But then at the end of that 5 to 7 years, yeah, if they've completed their business plan, then they're not going to be driving rents up a whole lot more than what they've already done. So your investment's not going to continue to just steamroll. You would continue to get your cash distributions, you know, so you're 7-8%, but you wouldn't. That would be all the returns you'd be getting. Does that make sense?
Yeah. Okay. Got it.
So that's why they'd rather sell and let you get into another deal and give you
Okay.
that big wallop of returns.
Got it.
So, but to answer your question though, you get your money throughout. They don't hold it for you or anything like that. That's something that you get. And welcome to the other 2 listeners, Christina and Nayara. I'm sure I butchered that, and I apologize. But welcome. Good to have you guys here.
Thanks so
Thank
much.
you.
So feel free, if you guys don't want to be on audio, you can type questions into the chat, and I'll help you answer those. So as far as I know, we were kind of, before everybody got on, I was talking with Sheree about the being more of an active investor. And so the key components for being more active in your investments, as far as apartments are concerned, is you have several different key players in that. So you need somebody who's good at the analysis of a property. So that's the initial analysis. So what I just showed you was kind of the completed analysis that a passive investor would be looking at to see if they want to actually invest. When you are looking at different apartment deals, or apartment offerings, you have to see from an operating standpoint, hey, can we come in and complete our business plan and do it in a way that's going to make money for everybody that's involved? It's going to make money for investors. It's, you know, or is this particular property they're asking way too much, or, you know, it's in an area where the price is going to get driven up by other buyers. You know, that's something that has been happening more often with, you know, apartments. And that's, if you hear the term cap rates compressing, that's all that means, is that things are getting more expensive. you typically want to buy properties that have a little bit of a higher cap rate or cap percentage. And so that just means that it's a cheaper property. You're buying it, for less money, and you can come in and you've got more wiggle room to carry out your business plan. So you need somebody who's good at the analysis part of it. And that takes time to develop that. You just have to put a ton of properties kind of through the grinder and see which ones make sense or don't. So that's one key component. You need to have boots on the ground for your due diligence and stuff like that. You need to have good contractors, good people that are going to be able to come in and work on the property, do the renovations that you're looking to do, or implement those parts of the business plan. And sometimes that can be taken care of by your property management team. So if you've got a good property management team that you're planning to bring in, they will often have contacts for some of that stuff that can really help you out. So let's see, you need investor relations, somebody who's going to kind of take care of being more of the face of your organization to your investors. So, and it depends on how big you're looking to go. I mean, obviously, if you're looking at some joint ventures on apartment deals with just you and your partner, and you want to go and buy, a 15 or 20 unit property and just kind of split it with somebody, then that's a little different, but when you're talking about getting up into 40, 50, 100 units, 200 units, you really have to have a good team in place to really carry out your business plan in that way.
As an
So-
investor, how much say do you have in what happens in how they manage the property, or you just have to go with what they decide?
So basically, yeah, it's kind of like buying a stock. If you go and you buy Amazon stock, you own a piece of that company, but you're not going to walk into the boardroom and start calling the shots. So that's, you really don't get much say as a limited partner, and that's where the term limited comes in. You're on that side of it. You're limited in what your say is. So you can obviously ask questions and make suggestions, but whether or not those are really considered just depends on your own individual relationship with the folks that are running that business and are on the general partner side. But yeah, I mean, from a limited partner, passive investor standpoint, you're really, and this is a key part. I always say that you're investing in the operators. It's not always about the individual deal. You're investing in the operators, which is why it's important to find a good team, a good group that has an established track record of doing well. And I don't like to invest with a brand new group out of the gate that doesn't have the experience and hasn't done this before, because they're going to learn on your dime, essentially. So if you've got a group that's already done several deals, or they've done things through downturns and you've seen how they've handled that, then I'm much more confident in investing in them. And in those instances, sometimes it doesn't even matter what as much about the individual deal. You're looking to have your own version of a portfolio with these investments. So like for me, I invest in A, B, and C properties. I don't do D. And I want the bulk of my investments to be in B and C properties, because those weather the different upturns and downturns of the economy better. Okay. And I have, and what I like to do is I like to have most of it in B and C, but some in A. And then I like to also have it spread out in different markets across the country. I could invest exclusively in the Southeast. I know the Southeast very well. And so that, and I could do very well doing that, but I like to have, a little bit more diversity with where I have properties at. So I mean, I have properties in North and South Carolina, but I also have a property in Idaho, in Boise, which is a great market, and I have another property that's in Colorado City that I've invested in. So
Do you visit the properties just to kind of see what's going on or show face?
I have, and you can, and so and what I would do if you're looking at doing that yourself is that you can actually just get a hold of the management team and say, hey, you know, I'm an investor. I'd love to see the property. I went and did due diligence on a property that I was looking at investing in. You know, and this was before they had actually purchased it, and I was thinking about, you know, if I was going to be a part of the general partnership, I wanted to be a part of that process. And so I went and I did due diligence with this group on a property, and I mean, it was great. It was very eye opening. You know, the nice thing about investing in real estate is you can go and touch it, and you can see what they're doing, you know, and get an idea of how things are progressing. And so the things you want, you know, obviously a good operator is going to do certain things just very well. And so you want operators that are communicating with you on, you know, a monthly to quarterly basis on how things are going on the investment. So I typically get monthly statements of how the investments are going. And so you know, you'll get that information from your operators. And if you're not getting that, then that's a red flag. And that's when you'd really want to be like, hey, I need to go see this property. I need to go talk with the management team and see what's going on, because I should be getting more updates than I am.
So were you considering being a GP, but so far I've only stayed in LP, or are you doing
So far? Yeah,
Okay.
I'm looking at becoming a GP with some different deals down the line. That's my goal. But we'll see, you know, where the winds take me. I'm looking at some JV projects as well. So those are typically smaller. You know, you can take a smaller apartment deal down with just a few people. Whereas with some of these larger deals, obviously with $14 million needing to be raised, that's a lot of money. And you have to have a lot more investors. And so that's when you have these larger structures with the general and limited partnerships set up.
Yeah, I signed up to get your emails. It's probably been about 6 or 7 months.
Okay, great. What do you think of them? I always like to
They're great.
ask.
Yeah, they're really great. I learned
Okay.
a lot. I think I got all of them, and then quickly in like one night read through. You know,
Oh my gosh.
so I was like, oh, this is a lot. I need to go back and spend more time with this. But
Yeah.
it definitely got me more intrigued on thinking about going syndication.
Cool. Yeah, I tell you that for my money, I just can't beat it from an economy of scale standpoint. I bought a you know, a single family home, and this was really the first real estate that we got into, and it was just before I started to learn about apartments. And we bought this. It was supposed to be a turnkey property, and it turned out to not really be as turnkey as it was supposed to be. You know, made the mistake of, you know, it wasn't rented when we bought it, and so it sat vacant for a while. You know, had an AC unit that was stolen, had to replace that before we had even, you know, we never even had a resident in it. And that's, so the insurance didn't cover that. And, you know, but all these things, you know, I learned so much. It was an expensive lesson, but I learned such a good deal from it. And so, and I do my best to kind of carry that over into the apartment space as well.
So is that as far as getting your start in investing, you kind of started with more residential and then worked your way to syndication, or did you quickly scale to syndication?
Oh, that's the only rental home we have. And I mean, it makes money now, but after that, so it was really just the banks were a pain in the rear end. And so initially we were listening to Bigger Pockets a lot, or I shouldn't say we, my wife doesn't do podcasts, but I was listening to Bigger Pockets a lot. And we were kind of getting into the idea of having a rental home portfolio. And I knew that you kind of you had up to 10 loans that you could get for single family properties before you really had to go kind of a different route for raising that funding. And
Mhm.
so I said, well, we'll try this out and we'll see about scaling. And I had all these different, models written out and how this was going to look over the next several years. And we did the one property, and the banks were such a pain in the butt. It was like, I can't imagine doing this 10 more times, And so then we found out about the apartment stuff. I started to get a couple of deals that came across my desk from, these different operators. And I saw this one and I said, well, let's go for it. Let's try it out, and within 3 months, we were receiving checks in the mail, or into our bank account. And it was the smoothest process. Basically, hey, okay, well, you signed a couple of these documents, and then here are the wiring instructions for the money that you need to wire over. And that was it. And I mean, we haven't looked back. After
That's
I did
amazing.
that, I said, oh, I'm not doing this single family thing. Mm-mm.
Yeah.
So
And then how long did you give yourself before you quit doing anesthesia?
well, it was about that same time actually. And it was my youngest daughter was in a daycare that was associated with the hospital that I used to work with. And I had gone 1099 like 3 years before. And I happened to be in kind of a down period for that. I was only working 3 to 5 days a month. And the daycare center that my youngest was at, they looked at it and said, well, you and your wife haven't worked here in several years. And they went through a change in management and stuff. We had it worked out with the previous management, but then they went through this big overhaul. So the new management came in and they said, well, you haven't worked here in a few years. We'll give you 30 days. And I mean, you can't find a preschool in 30 days.
Yeah.
So at that time, and my wife, she works for the school system here as an occupational therapist.
Okay.
And she carries our health insurance and stuff. And, she already had, the weekends and holidays and summers off and stuff. So we said, well, I'm already not working much at all. So let's give this a shot. And so that's when I just started developing the side income from the apartments. And no, I mean, I don't make nearly what I used to make. I didn't have that much money to put in. But we make enough to cover the bills. And, my wife's still working. It's, the goal is ultimately for us both to be able to walk away. But, I was able to stay at home with my youngest and kind of do the stay at home dad thing for a while. And I tell you, it's been great during the pandemic because I mean, well, I'll give you an example. Okay. So we talk about, just having freedom, just having time freedom. And
Mhm.
so my wife and my oldest daughter went on Tuesday night. They just went and drove about an hour to Stone Mountain, which is near us. And they went and kind of had a picnic dinner, just the two of them and stuff. Well, my daughter, they get halfway home or so, and she realizes she left her shoes and socks in the parking lot of the place at Stone Mountain. And so I say, okay, well, let's just hop in the car and go the next morning. And so we were, if I were working, I couldn't have done that. It's a Wednesday,
Yeah.
I couldn't have done that this morning, but we took 2 hours and drove there just to get that pair of shoes and socks and then drove right back home. And then she was back in time for her schooling, so it's just the freedom that it has allowed us. We're kind of conditioned to believe that you have to work 40 hours a week and you gotta put your nose to the grindstone. And the reality is that you can create whatever kind of lifestyle you want to. It just depends on what you really want and what you prioritize in your life.
Yeah, definitely.
So,
Yeah, we're definitely on the podcast, audiobook, reading books kick.
yeah,
Right?
cool.
Put an offer on a place this weekend, so we're hopeful.
Have you listened to my podcast?
I haven't listened to your podcast yet.
Oh no. Okay. Well,
I
you'll have
will
to.
add it to our list. Yeah.
It's pretty cool. Yeah. The Plan B CRNA podcast. And I interview all kinds of different people. I don't, I love apartment investing, and that's more my thing, but I'm all about investing in other ways too, and seeing how other people develop their little side hustles and side incomes. And I went through a lot of that when I was looking for stuff.
Yeah.
So
Gotta
it's,
find your niche.
yeah. So it's something out there for everybody. I mean, when you got a kid that can open, Amazon boxes on YouTube and make 10 million a year,
Yeah.
it's hard to believe. Like, there's just so many different ways to make income now that weren't available 20 years ago.
Yeah. The internet,
So
an interesting beast. That's for
yeah,
sure.
but I do happen to really like apartments and apartment investing, and that's worked out well for my family.
Yeah.
So
No, I saw something that you had posted on one of the CRNA Facebook groups quite a while ago when I signed up for your emails, and I've definitely been intrigued. But I changed jobs, I moved, and then we thought, well, we kind of have to start and work our way up. But I don't know if that's really the truth when it comes to the apartment syndication and being a limited partner.
mhm.
It sounds like if you find a good company or a good group to get in with, it's a game changer. So
Yeah.
for sharing
Yeah.
information.
And that's, my goal is to work with those kinds of operators and provide those types of opportunities to folks. And that's, I mean, I could try to be a lot more flashy, and I could try to, do a lot more marketing and do a lot more stuff, but, I value my time too. So, it's one of those things that, this is more of a passion project for me. And, that's kind of why I do it. My income's going to grow over time, no matter what I do. And, with this, it's going to continue to grow because the investments that I'm in are going to do well over time. But, this is something I was amazed that this was even a possibility. And so many people have zero clue.
Yeah.
You're supposed to go to school, and then you go to work, and then you put all of your money into your 401ks. And, and for me, it's become a lot more about focusing on creating cash flow. Your retirement is all about cash flow. Like, how much money can you get off your retirement? So why would you, just sock money away and then slowly draw off of it and hope that it's going to last,
Mhm.
when you can really invest, differently, and create that cash flow that continues to grow and appreciate over time. So,
Yeah.
um, the name of the podcast was the Plan B CRNA podcast. I'm going to type that in the chat. Oh. You know what? And I bet I could get you a link to that too in just a second. But that's the one it is. And you'll find it on any of your podcast players. So biggest challenge I've had, you mean with apartment investing, or how do you mean? Because I really haven't had a ton of challenges with apartment investing. The well, okay. So I will say that the biggest, let's see, I'm not an accredited investor. So that tends to limit your deal flow. And so how many deals you get access to and that you can actually invest in. So that slowed me down a little bit because, and to be an accredited investor, you either have to make $200,000 a year on your own, $300,000 with your spouse, or have a net worth of $1 million. And prior to some of these different laws that passed in the past decade, accredited investors were the only people that could invest in apartments. You didn't have the ability as a non-accredited investor to get into these deals. So that's been the big game changer in the last decade. So for me, it's still a lot of the deals that I tend to see are for accredited investors only. my goal is to be able to offer deals that aren't necessarily that way. I want to offer both. The 2 deals that I've offered so far have both been for accredited investors, and that's just, kind of roll the dice. That's just how it worked out. But I want to have more deals in the future that are for what are termed to be sophisticated investors. So these are folks that don't maybe meet that income or net worth threshold of being an accredited investor, but they have sufficient knowledge to be able to assess the risk of what they're getting into with an apartment investment. So let me get the link real quick for. So anyway, yeah, feel free to hit me with some more questions if y'all have them. I'm going to put in the link to the podcast right there
Yes,
in the chat.
I still have another question.
Yeah.
Let's talk about real fast about building classifications. Saw you're showing a portfolio there. It was an A class building. Have you invested in a C class or in a B class? And if you did, which one you saw it was worth investing in? I'm not even going to go to D class.
Okay. Yeah. So no, I don't do D class. I do know some folks who do. But it's just not something I'm particularly interested in. I do have an investment in the one I showed you. I guess it's kind of a like I said, a B plus to A minus. So it's right there on that line. The definitions can sometimes be, fluid, but I am invested in a C property and another B property as well. That basically they're both performing well. They're both doing what they're supposed to do. The business plans are being carried out. Those are properties that are both in South Carolina, and I know the area there in the Spartanburg, metropolitan statistical area, Greenville, Spartanburg area. So I know that MSA. I know it's a good area to be, and so I feel comfortable with those investments. And the general idea when you're looking at investing in B and C class properties. So if you're in, let's say a B apartment, okay, and you have a downturn in the market, okay, you got people that are losing jobs or getting job cuts or salary cuts, whatever. So if you own a B property, you're going to have some of your residents that maybe can't afford to still live in that B property anymore, so then they're going to move down to C properties. But you're going to get some of the overflow from the people who live in A properties who can't afford to live there anymore and have all those amenities and stuff. And so they downsize into a B property. Okay. And that's really where, when I say it's able to weather those kinds of storms, B properties are more, B and C are for working class folks that, they're pretty reasonably priced for whatever area they're in. And you're always going to have people, you're always going to have demand for those apartments. And so that's, again, where it comes to the area you're talking about. So do you have good population growth, good jobs? Is it a good city to be in? And then, of course, your neighborhoods matter as well. But that's where those investments really do well, because you can have, and if you have an upturn, if you have an upswing, okay, well, you might have some people that live in your community that decide to move up into a nicer apartment, but then you get the people from the C class that move into the B. And so you always have kind of this fluctuation that can occur, but you're covered. Your residency, your vacancy rates will always be low because you always have that demand, no matter, from either end or the other. Does that make sense?
Yeah, it makes sense.
Okay. So, and I did just happen to look at the time. If anybody has one last question, I'd be happy to answer it. Otherwise, we'll just go ahead and wrap it up.
Well, I'll have one more question.
Yeah, go ahead.
So, it's just I don't understand this one part. I heard that it's not good to invest in an apartment that has a high cap rate. I don't know if that's true or if it's true, if it's not true, and I don't really get why. Why it would be better to invest in an apartment there's a 6% cap rate instead of a 10%.
So this it can be a little complex. That statement just taken by itself is I don't think that's accurate. But cap rates vary depending on where you're at in the country, and so it depends on the value of properties and how expensive things are. In general, if you can buy at what an apartment investor or what apartment owners are looking to do is buy at a higher cap rate and sell at a lower cap rate. Okay. So if you're in an area where the cap rates are typically 6% and you find one that's at 8% and you can purchase it, you can make capital improvements. You can, turn over some units and charge higher rents and figure all that out. Yeah. And increase the value of the property and then sell maybe at a 6 cap later on, and you will have made more money. Okay. So that's where my, if you got somebody telling you don't buy at a high cap rate, well, that's what people do in the apartment investing industry is they try to buy at a higher cap rate than they plan to necessarily sell it later on, if they can. And that's something that just depends on your area. That being said, cap rates are often determined by the area that you're in. And so different area, your cities and things like that, you'll see like out in California, you'll have cap rates that are around 4 or something, in different areas. And so it is what it is. If you're going to buy in California, you're going to pay more of a premium for some of those properties. And part of that's because of the bidding war from different apartment investors that want to come in and purchase a property, and they're willing to drive the price up. It's, we're not at the days where we're only 3 or 4 offers on a property. Now you'll see a property have 15 offers on it or 20 offers. And so trying to go through all of that is, that obviously drives the prices higher, and that in turn drives the cap rates lower. So that's where we talked about earlier with the cap rates compressing. That's all that means is that cap rates across the country, when it comes to apartment investing, cap rates are dropping. The price of properties is getting to be more expensive than they have been. And part of that is because of the influx of capital from people who were previously investing in the stock market. And, the stock market's been doing weird things. And so people don't feel safe in the stock market. They feel like it's overblown or whatever. So they're taking their money out of the stock market and putting it into real estate. Some of it has to do with those laws I talked about changing and allowing people to more easily invest in apartments. So all of that has resulted in more of an influx of investor capital coming into apartments. And so that means there are more people hunting for deals, more people looking at apartments, more eyes just drives the price up. So, but, to answer your question, sure, if you're in a cap rate area that's, around 4 and you buy a piece of property that's at a cap rate of 10, if it's that drastically different, then I do have to ask, like, okay, well, what's going on with this property that, are the vacancy rates so bad that it's driving the price of that property down? What is wrong with the property or where it's located? And so to me, it's not so simple to say, I don't want to invest in high cap rates. That's not the case at all. Every offering is going to be an individual investment. And so you want to really look at that from that kind of a standpoint. Does that make sense?
Yeah, it does. Thank you.
Yeah, you're welcome. So, and with that, I think I'm going to call it an evening, guys. we've gone a little over, and I've appreciated all the discussion. And yeah, Christina, reach out sometime if you want to set up a phone call. We can talk, about just what you're looking to do, what you're looking to get into, and how you're looking to invest in the future.
Okay, yeah, sounds good. Kelly Williams, who was on earlier, we are good friends. We work for the same anesthesia group. So
Oh, great.
we've talked, she has a short-term rental. We've talked about maybe partnering at some point, but I think syndication just kind of gives you that group feel, and it's really nice, and takes some of the pressure off going into a short-term rental or multifamily, just the two of us. So
Okay. Yeah. No, I like it because I've been able to learn while still, kind of being on the sidelines, but you still get all of the information and stuff, and you can ask the questions from people who are just super knowledgeable about it. So it's a great experience. So
thank you so much, Bobby.
You're welcome. Take care. We'll be in touch.
Sounds good. Bye all.
See you guys.
Good night.
Good night.
Nice.
Good night.
Thank you so much for joining me for another episode of the Plan B CRNA podcast. If you haven't already subscribed and reviewed the show, I'd be honored if you took the extra time. It really helps to expand our reach and get the word out about the show. If you're a CRNA who is interested in sharing your story on our podcast, I'd love to have you. Please email me at bobby@oncallinvestments.com for more information. This episode was brought to you by On-Call Capital. They are dedicated to helping providers like you develop passive income and generational wealth through investments in the apartment and alternative investment spaces. Feel free to check out their website at www.oncallinvestments.com and subscribe to their free educational email series. You can find On-Call Capital on Facebook, Instagram, and Twitter. You can also check out our YouTube page, where you'll find all of the show episodes along with other educational videos. Thanks for listening, and we'll see you on the next episode.